Hello, my friends. Brett Pattison coming at you from the financial capital of the West, joined by the chairman, Brian Hunsaker.
What's going on, Brett?
Happy February, Brian.
Thank you. Yeah.
It has been a great year so far.
Yeah.
The S&P 500 is up year to date 4.71%. Who knew?
Yeah.
That's a great January, by the way.
What do you think about that? 4 into, times 12. That's a, if it continued, of course.
Well, let's talk about that. We are
not suggesting that or recommend.
You are saying we're going to be up 60% this year.
No.
We're up 4.7% this year, 4.71%. We are almost hitting 5,000. Like we may be hitting 5,000 as we're talking right now.
Yeah.
It's the S&P 500 is at all-time highs, which is great, right? We're going to talk about that all-time highs here in a second. Know this, my friends. I am a probability investor as it relates to options and just like to know the probabilities. And did you know, you did know this, Brian, because we talk about these probabilities. In a given one-year time frame, there's, from the history of the stock market, there's a 73% probability that the market will be up in a given year. That's a pretty good probability.
Yeah. Basically 3 out of 4 times.
Yeah.
Every 3 out of 4 years, the market's up.
Here's the crazy part.
I like those odds.
There's something that people call the January barometer. That if January's up, typically the year is up.
Mm-hmm.
Probabilities would say that if January is up, going back to post-World War II, there's an 86% probability that the market is up in that year, with an average around 11%.
Yeah.
Not your 60.
Yeah.
So sorry about that. An average of 11. And we're already up 4.7.
Yeah.
If probabilities, if averages, which hardly any time we see the actual average, but just it's been a great start to a year. Don't think that this is going to be every month. We should be up according to history and probabilities. No guarantees. And we've already made up a large part of that in the first month and a half, right, of the year.
Mm-hmm.
So anyway, from a probability perspective, that's where we are. But here's the big question today, Brian.
Okay.
Here's what I'm seeing in the media. Okay? Psychologically, too, clients, non-clients, friends, family have the same thought process. And here's the thought process. Bear markets. Market starts going down. Great time to invest. But guess what you hear? Guess what the gurus will tell you? Wait, because it's going to get cheaper. Okay? So that's what you hear in the bear market.
I think you hear the gurus, and I think that little voice in your head's telling you that too. I mean, a lot of people.
Psychology.
It's the psychology of markets. We call it recency bias. You look at what's happening right now and you sort of project that, whatever it is. So if it's markets are good, you project that going forward. Markets are bad, you kind of project that, going forward as well. I would say just be careful about that. I mean,
but it's kind of different on the upside because I think most people are pessimistic just in their nature. And they're worried. They're just worried all the time, especially about money. And so what happens when the market's trading at all-time highs like it is now, what do people say? Let's wait. Can't go any higher. The market's too expensive.
Yeah.
This whole notion of the markets being too expensive. Let's talk about that for a second. When people say that, what do they mean? What are they even saying? The market's too expensive. We can't invest now. We're at all-time highs. We missed it. What does it mean, and what would you tell people like that?
Yeah, when we talk about the value of the market or the value of a business, we're talking about the earnings of a business relative to what you pay for those earnings. That's what we're talking about. And so right now, people are saying, "Hey, the market's up. It's a lot more expensive than it has been." Say, especially in 2022, the market was down. What you were able to buy in 2022 per dollar was higher because earnings relative to each dollar you spent, you were getting more value for that dollar than than today, where you're paying a little bit more for those earnings. That's kind of what people are talking about.
So when people say the valuations, the PE of the market's what, 22, 23 right now, somewhere in there, of the S&P 500?
Yeah, depending on how you're looking at it, we talk about forward earnings. We talk
Yeah, so
about
those are not forward. Those are trailing.
trailing earnings.
And I hear a lot of people saying, way too expensive. Tell us why that's dumb.
Yeah. Well,
maybe not necessarily dumb. That's a little harsh.
Yeah.
But why wouldn't I say we're at an S&P 500 multiple right now of 22? Historically, that's on the high side. Why wouldn't I invest?
Right.
Why would I invest?
Yeah, historically, if you say the last 50 years, I think the average PE multiple is in the range of 16 to 18, 16, 17 times earnings. That's historically been the valuation of 16 to 17 times earnings. So if you had $1 in earnings, you'd pay 16 times that, or 17 times those earnings. That's what we're talking about. And
that's the average.
That's the average. But a lot of times when you hear talking heads on CNBC or Fox or whatever, some article, they'll reference the trailing earnings.
Mm-hmm.
And what are trailing earnings? And say, for example, what the earnings were last year or the year before relative to what you're paying today.
Yeah.
And I don't look at it that way. I never look at it that way.
Why?
Because you're looking in the rearview mirror. I want to look forward.
Okay.
What are earnings going to look like this year? What are earnings going to look like next year?
In the next 3 years.
Next 3 years.
5
next
years.
5 years. So I look at the market in general, just like I look at it as a stock. It's the same approach. When I look at the business, look at a business, I'm looking at what earnings. I do look at last year's earnings, but I'm looking at more in terms of what will earnings look like over the next 12 months, the next 24 months, the next 36, and so on. And if I see a business that's growing consistently, and I'm paying a reasonable multiple, and I think that's a very attractive business, a very attractive business opportunity. So the growth of those earnings is a big part of value in a business, the future growth of those earnings.
Yeah.
Or lack of growth, that goes into it.
So here's the question then. If we're looking at the growth of earnings, that's what matters. Not looking in the rearview mirror. Looking forward.
Current earnings and the growth of those earnings.
Okay, current earnings and the growth.
Things. Yeah.
How in the world do you forecast that? And let me give some kind of a backdrop. Okay? We're looking at, say, Microsoft, which is on the edge of the AI potential boom that we keep hearing about. We're looking at their earnings, and they're coming out with new innovative products. How do you get your mind around, okay, Microsoft is cheap or expensive based on what's ahead the next 10 years in a AI environment that we may not know?
Yeah.
Tell me your process for thinking about that.
So that's a great question. We've kind of talked about this before, and it's a really hard question. Actually, it's really hard.
It is hard
because you're looking at. I'll look at the historical growth of Microsoft, and I'll look at the last 3 years, 5 years, 10 years, and then look at the current business. We listen to management. What are they saying about the future? What are they looking at as far as growth and their expectations going forward? So we're pulling all of that data in to determine what is an appropriate growth rate for those earnings going forward. So really, we rely on management.
Yeah.
And that's why it's so important that we trust management and we feel like they're truthful to us as investors. So that's probably the greatest source of where we are able to forecast or look forward to earnings. And then there's a whole another group of people who are analysts, who are making projections about the
Oh.
business. And so I do look at analyst projections. So I look at analyst projections, look at management, and then I look at historical.
And we even have analysts that we trust and some that we ignore.
Right.
Yep.
Right.
So
it's three things: management, analysts, and then looking in the rearview mirror, basically.
And we side on being a little bit more conservative with those growth projections. Is that fair to say, or no?
I would say that. Yeah, I'd say we do for sure.
And part of the reason why I ask that is when you hear expensive stocks, people in our age group always think back to 2000.
You're putting me in your age group? Thank you.
Yes, you young whippersnapper. We always think back to 2000. Mm-hmm. And in 2000, that's when the internet boom was happening, right? Really the 90s. And valuations were out of control. And so when people think expensive, that's where our mind goes. So we're on the next boom, which is AI. We have no idea what it looks like. It's supposed to be as big as the internet. How do we do this? How do we prevent buying things that are too expensive, but still buying things that can capitalize on good future earnings growth?
That's a great question. I mean, for example, Microsoft, back in the dot-com era, I felt like got too expensive. And actually, if you look at history, if you look at the performance of Microsoft going from the end of 90s to 2010, I don't think it ever made money if you invested.
Yep. It was just an income dividend flatliner.
Right. Now,
and part of that, though, was management.
Yeah. I mean,
because Ballmer was a great dancer if you've seen the YouTube videos. If not, you gotta Google it.
That and then kind of his Yahoo.
Yeah. Yeah.
Funny guy.
Management took a step back.
You know, he's the biggest shareholder of Microsoft right now.
Still.
It's crazy.
Wow, he's nuts.
He's got more stock than Bill Gates.
But Nadella came in and put that company on a different path.
It's amazing.
Management is so important, Brian.
Yeah. We're talking about Microsoft. And Microsoft has had a rebirth, in my opinion. Yeah. It's amazing.
Right when Nadella came in.
Yep. It's amazing what's happened. But I will say, Ballmer, everybody kind of gives Ballmer crap about, the performance while he was, and performance wasn't good, but
no,
he kind of took over when valuations were so high.
Yeah.
And if you look at the underlying growth of earnings and revenue when Ballmer's, they still grew. It's just that the valuation was wacko. But going into the late 90s, valuations did get extended. I mean, not everywhere. In fact, Irongate, we had some of our best best returns coming
against
out
the
of
S&P.
Well, not just that, and also just real returns.
Yeah.
And we had, the market was down. Anyway, we don't want to talk about that, but I'm just saying that valuations do matter. I 100% believe that. But when you got an asset that continues to grow, like the S&P 500 continues to grow, has for the last, many decades, and I believe it will continue.
Okay, give me an idea. When you say S&P 500 grow earnings, right? What's been the average earnings growth in a given year on the S&P looking at history?
So I'm kind of nerdy this way. I have this spreadsheet.
Well, this is a nerdy podcast. I mean, we're being nerds today. This is great.
This is actually one of my prized possessions. I love
it's
this.
His holy grail.
I have this data going back 64 years. Okay. It's older than me. Okay.
Young
4 years before I was born, going back to 1960.
Okay.
And it has the earnings yield, the 10-year treasury, the dividend yield, the S&P 500, the price, the change,
big time
the
nerd.
Earnings, the PE multiple. And then I have the rolling, 10-year earnings growth, 15-year, 20-year, etc. And I have all kinds of data.
So what's the average earnings growth?
So the average earnings growth going back 64 year, earnings have grown 7.1%. Let's see, where did it go? I think it's 7. 7.1%.
Right around 7, a little over 7%.
A little over 7%.
And what has the S&P 500 done in that same time frame?
7%.
Without dividends.
Without dividends. Yeah,
So
dividends, that's a little bit more than that. But basically, there's almost a 100% one-to-one correlation between the price change over a long period of time, the price change in the S&P 500, and earnings change.
Okay, so going back to the question. If people are putting money to work in a bear market, they're getting a better bang for their buck in a bear market. Their returns have the potential to be great. But you're saying right now, if I invest my money right now, I can still get pretty decent returns, not as good as buying in a bear market, but pretty good because earnings will continue to grow in the market and specifically the stocks that we buy.
So you think about it this way, at 7%, which is the historical average of earnings growth. I mean, and I can look at a 10-year, for example, the 10-year earnings per share growth is 8%. The 15-year is 10%. The 20-year is 7%. So it's anywhere in that range.
Yeah.
But you think about it in this terms, at 7%, earnings will double over the next decade at 7%. It's the rule of 72, which means that the S&P 500, there'll be pressure for it to double over the next 10 years, depending on the multiple you pay for those earnings 10 years from now. So maybe the multiple goes down, but I look at the multiple in the S&P 500. I think it's a reasonable multiple. You're paying a little around 20, maybe a little less than 20 times earnings, forward earnings. And I expect earnings will double over the next decade. So it's not irrational, the valuation on the market. So, which means to me, you can buy the market today, and over the next 10 years, you're going to have a good result.
Yeah. So, okay, client has $100,000, $500,000, $1 million in cash. What you're saying is still okay to put it to work.
Well, and I think the way we do it makes a little bit more sense in that we are buying individual companies, individual businesses, and we pay attention to valuation. And when we think a valuation looks attractive, we buy it. And when it doesn't look so attractive, we love the underlying business, but maybe the valuation doesn't really excite us. We might just dip our toe a little bit. And as markets always change, there's always fluctuations up and down.
Yep.
We'll have an opportunity to put that money to work when markets, get a little volatile or go down a little bit. We'll put a little bit more money in. And I think that's an rational, intelligent way to invest money.
Yep. So if you're sitting on cash and you're listening to the media say that the market, it can't go any higher, we're at all-time highs, or it's too expensive.
You hear that all the time.
Ignore them.
I ignore it. From time to time, you get them too. We have clients that forward us a YouTube videos, some guy that he advertises, he predicted this or predicted that, and he's predicting, doom and gloom and the market correction. And I've been listening to these guys, hearing these guys for the last 30 plus years. I ignore it. And those guys, I mean, if you want to make money, you buy a good business, you hold it a long period of time. That's the bottom line, end of story.
Yep. Amen, brother. So the bottom line is what we're saying is still not a bad time to put cash to work.
No, it's
not.
Or
to have somebody with a proven process put it to work for you.
Right.
Which is IronGate.
Yeah.
All right, my friends. Here's to a great start to a year.
Yeah.
Tamper your expectations, Brian. It's not 60% this year. I'm confident in saying that.
No.
All right. Until next time. Bye now.